Morning, welcome to the new week. It's Monday, the 10th of May. Big week for gold and a big miss for the US. Somewhat quietly, last week was potentially very instructive for the price of gold going forward from here. This move was punctuated by the abysmal US non-farm payrolls Friday night and what that really maybe means. But first, let's acknowledge and celebrate gold's strongest week in over half a year, convincingly smashing back above 1,800 US dollars to 1,840. Into a 3-month high, technically too decisively moving past the support of the so-called double bottom through the $1,700 resistance line has given analysts a lot of confidence that the 7-month fall from August last year is over. Here's that chart here. For silver, the news is potentially even more bullish as it rides the commodities run as well. On another strong week for commodities, among growing demand and inflation concerns, only copper just outperformed silver, both up 6%. For context, copper is now at an all-time record high and up 90% for the year. Not bad company. Here's that chart here. Bit hard to zoom in on that one there, but does show comparison between those commodities for you. However, technical analysis and prices are one thing, but where's the value? Price is transient and value lasts. The value proposition of gold, silver, platinum, and the likes of Bitcoin and Ethereum is, like nearly everything, relative to their assets. For something to have a price, there must be a denominator. Its value is relative to that denominator. For the world more broadly, that tends to be the US dollar. At home, more likely the Aussie dollar. But more personally, again, it's against whatever your benchmark, say how many ounces of gold to buy a home versus the median house price. For now, though, as the world's reserve currency carrying over 80% of all trade, and by far the biggest denomination of global debt, it's the US dollar. We and many others write continually of the unprecedented debasement of the US dollar through the actions of the US Fed and government creating and spending it at an absolutely unbelievable pace. As a reminder, over 25% of all the US dollars ever created was created just last year. And that was just before the nearly $4 trillion in stimulus from Biden being unleashed. Such stimulus is supposedly temporary to get America going again. However, we again have written continually of the trap that financial markets are completely dependent on it, and the debt burden now so big it cannot handle higher rates if natural forces were allowed to prevail. It is the much discussed Fed trap. On Friday night, we saw the monthly US non-farm payrolls official employment figures released, expectations for around 900,000 to over 1 million new jobs created in line with the everything is awesome narrative. In the second biggest miss ever, the print was just 266,000 new jobs, and the unemployment rate actually went up to 6.1%, not down to 5.8% as expected. But wait, there is more. The previous month was also revised lower by 146,000 fewer to 770,000 on actuals. That's jobs. However, there are still over 8 million fewer Americans employed now than before the pandemic. Part of this is there are simply sectors still knocked out, and these people can't take the jobs on offer. But a large part remains the fact that many are quite happy to take a generous dole and take a low-paying job. The more cynical and aware of the Fed trap can see this as convenience. Pay people to stay at home, get weak employment data, continue to keep easy monetary policy, and don't blow up the ship. The following chart we're going to show you puts into clear perspective the amount of money being dished out to US citizens just now. Check out this chart. Government transfer payments as percentage of total income. What is becoming more abundantly clear is that we will be in gold's sweet spot of very negative real interest rates and looming economic reckoning for some time, and many will be late to see this amid a narrative of recovery. This is good news for accumulators now as the price slowly recovers. For now, the Fed must keep their rates low and printers going brrr, and inflation will be here, be it on the measure of more dollars buying fewer or same goods or plain old wages growth, to beat welfare and to entice some of those 8 million at home, or to supply constraint price rises. And if not, out of control neutral rate rises on the bond market, overcoming the Fed funds rates, sees this whole debt-laden ship sink. There is very precious little freeboard as it is. Should that happen, history shows us time and time again that precious metals prevail. That is the point where value versus price makes a whole more sense. Well, thanks for joining us this morning. Great Monday news, and also great to see a price rise there for silver and gold, starting late on Friday last week. Remember ainsleyBullion.com.au for all things physical, gold, silver, platinum. ainsleywealth.com.au for all things cryptocurrency. If you haven't grabbed a piece of Bitcoin, you can do so now through Ainsley. And goldsilverstandard.com for a more portable solution for gold and silver that's built and backed by Ainsley and pegged to the live price of gold and silver. Enjoy your Monday, everyone. We'll catch you tomorrow for more news.